Didi Global Inc., the Chinese ride-hailing giant, has been gearing up for a much-anticipated IPO on the New York Stock Exchange. Its debut on June 30 raised about $4 billion in new funding, giving Didi a valuation of $67 billion. We can think of Didi as Uber of China. And Uber is in fact a major investor in Didi, though not as its first choice. Didi has been so competitive that Uber decided in 2016 to seed the Chinese market. Uber sold its China operation, and in return it retained about a 12% stake in Didi. You could call it a win-win. Like Uber and Grab in Southeast Asia, Didi also struggles with profitability. We have incurred significant losses since inception, and we may not achieve or maintain profitability, Didi wrote in its IPO prospectus. Didi did earn profits in Q1 this year, but that's largely due to a one-off investment and not from ongoing operations. Still, like all things in China, Didi has grown in a market where speed is unmatched by most countries. And it's the market dynamics that can foretell where the global ride-hailing industry is heading. The big gets bigger, but only up to a certain point. Most companies must make a profit to justify their valuation. The only reason the capital market has been irrationally generous toward ride-hailing apps is because they are platforms. Platforms are attractive because of the so-called network effect. Venture capitalists would argue that the value of a platform largely depends on the number of users on either side of the platform, drivers on one, riders on the other. The more people use a platform, the more inherently attractive it becomes, motivating even more people to use it. And once a platform reaches a certain size, it becomes too dominant to unseat. Except in ride-sharing, it turns out that the mere presence of one additional competitor can lead to ruinous competition. It's virtually impossible to differentiate product offerings. It's hard to think about the true differentiation between Uber and Lyft. It's not the sort of market differentiation that you see between an iPhone and an Android. Ride-hailing's network effect is also limited to one location. For instance, if you're using Uber in New York, you don't necessarily care about the service level in London. Uber's network effect is always local. In contrast, Facebook's network is global. Advertisers such as P&G and Nike care a lot about the size of Facebook's audience, from London to Hong Kong. The result? Ride-hailing can easily succumb to a price war. Discount coupons and driver incentives quickly eat into profit margins. The implication is this: a ride-hailing app can work only on dominating one market at a time. It needs a huge war chest to first kill off competition. Then it can raise prices for its broad customer base to restore profitability. And that's exactly Didi's strategy. Stick to one's knitting. Didi's dominance in China is unquestioned.